Hey there traders, how are we all? So it's been a while since I've put up my last video. There's been a lot that I've been doing in the back end, lots of macro level research as well to see where we're headed into, globally speaking, and also working on the knowledge base, working on writing a book as well about trading Forex. So simplifying everything so that you guys can kind of grab that book and then go straight from um, being a novice to becoming an experienced trader by the end of it. Now, this video is going to focus largely on the actual criteria that I personally use. Okay, in the last probably couple of weeks or so, I've done a lot of individual sessions with you guys, and I've been blown away by the results that have been coming through. So, it's been a year since I put up the first Forex Trading Series video, and 6 months now since the last of the 10-part series has gone up. For those of you that have watched those videos, that have started to follow the rules established within those videos, I'm amazed that you guys have now started to consistently bank 50 to 100 pips every single week. Especially in the last 2 weeks, it's been a rough market, and a lot of experienced traders have lost money. But there was about 6 of you guys that walked away with a minimum of about 40 pips. One guy in particular, 80 pips in a week that was extremely, extremely tough. So that's amazing. Now, for the rest of you that have not seen the Forex Trading Series yet, that's why I've got this up on my screen. What I want you to do is go up on YouTube, type in either Shiva Krishnan, which will bring you to my channel, or just type in Forex Trading Series, and one of my videos will certainly pop up. So click on them, go onto my channel and find the first one, which would be the sandpit, and then watch your way through to video number 10. They average between 30 something minutes to about close to an hour or so. So break them up if you have to, but in the series itself, I want to stress one point. In the series itself, that's the only thing that you need to know in order to be a successful Forex trader, right? And then that knowledge you can take on to applying to trading equities and other asset classes as well. Now, for those of you that are ready, grab yourself some paper, pencil, and a drink, and let's jump on to the charts, because I'm going to run you through now the actual trading criteria I use. From experience, this has got to be the simplest trading criteria that you will ever come across. And one other thing that I want to really stress is that despite all the courses that might be out there, all the books that will tell you that this is the only way to trade, I can tell you from complete experience, from being in this industry for a great number of years, is that pretty much everything out there is based off the same basics, right? Everything's built on the same basics out there. So no one out there is like an authority in the best way to trade forex, because everything, whether you're utilizing indicators, to whether where you give different names to impulse and corrective waves, to where we call patterns like double tops and double bottoms, M's or W's, or whatever it may have been. All of that sort of stuff have been around for years and years. It's not something that someone's just created, okay? So don't despair. Take whatever it is that you're doing. If it's somewhat working for you, apply what I'm about to share with you to it, and it will give you probably another perspective on something you've been doing previously anyway, okay? So let's do this. The first step is, and there are probably about 7 steps in this. So write this down. The first step is to determine the trend, right? We always want to trade along with the trend itself. It's a $5 trillion market. We don't want to go against it. If we do, it's going to be like a massive 10-foot wave that picks us up and dumps us. So what you've got to do is utilize whatever knowledge you have and discovered, and you get this in the Forex Trading Series as well, is to discover what the overall trend is doing. And you can do this on any time frame. So for us, when we're looking to collect only about 20 to 30, 40, 50 pips at a time, then what you need to do is possibly do it on the 1-hour chart or the 15-minute chart. So let's say for now, jump on the 15-minute chart and zoom out as far as we possibly can. On this chart, you're probably going to get about 2 weeks or 2.5 weeks worth of real estate. So it's the 1st of March right now. We're going all the way back to the 13th of February. That's enough to give us enough information about what the interim trend is, right? Because again, we're not going to be trading for multiple days, right? That's more for advanced traders. I do trade multiple days, but I don't want you guys doing that for the time being. So zoom out as far as you can. You can do it on the 1 hour chart as well. Now, the simple things to understand about trends. If the market or price in itself is creating higher lows and higher highs, and what I mean by that is here's a low, right? Here's a high. Here's a higher high, or here's a higher high than this point. Here's a higher high than this point. And this is also a higher high than this point. Here is a higher low than this point. This is a higher low than this point. This is a higher low than that point, and so forth. When you're seeing higher highs and higher lows being established, the market's trending up. When you see the reverse of that, which is in this case, we've got a high here, and this is a lower high, right? We can say here's a bit of a low, and this is a lower low. Same thing, lower low than this one, higher low than this one, right? So what we're looking to do now is just from that visual be able to determine if there's a trend movement that we recognize. Another way to look at it is to see if there is an existence of an Elliott wave structure. And for those of you that don't know what it is, Elliott wave structure is part of one of the videos in the Forex trading series. So if it's part of an Elliott wave structure or a structure that you recognize, that's familiar to you, that gives you some idea as to where this market is most likely going to head, right? Another way to look at, and before I go any further, one of the structures would possibly be, say, a cup pattern, a massive cup pattern that establishes itself over the course of like the week, multiple weeks, maybe the month or so, right? The other thing, or the other way to determine if the market is trending, is just to look at what the EMAs are doing, right? In particular, your EMA 50 and your EMA 200. So if you find that the EMAs exist in succession, the higher EMA, if that's at the bottom, the next high is just above that, and then the next lower one is just above that, and the next lower one is just above that one, like it is here, then the market is going to be trending up. If the higher EMA is up the top, followed by the lower EMA being below that, and then another lower EMA being below that, that would be in succession, the market is most likely trending down, right? So if you can kind of combine the usage of some of those Elliott wave structures, cup patterns, and look at whether EMAs are in succession or not, that's going to give you, to a large degree, some idea of whether the market is moving up or down or going sideways. Now, another aspect that you could really pay attention to is fundamentals overall. There's 3 areas that, when combined, give us the perfect formula for any sort of market movement. The formula itself is fundamentals plus technical analysis plus market sentiment will give you the results that you want in trading almost pretty much any asset class, right? So if you were to pay attention to fundamentals, and these would be looking to see if an economy is contracting or expanding, to see if the Reserve Bank, which pretty much their job is to control liquidity within the economy, if their focus is on either interest rates or their focus is on quantitative easing, that's going to give you, to some degree, an idea of the relative strength of a currency or the economy. And that should let you know that if, say, for instance, the economy is strong, then the currency of that economy is going to be strong as well. If the economy is weakening, then the currency of that economy is going to weaken as well. So when it's weakening, you'll have more of a bear market and the market starts to trend down. When it's strengthening, you'll have more of a bull market and the market starts to trend up. So that combined will give you an overall idea of what the trend should be. And when you jump onto, say, an hour chart and 15-minute chart, just the visuals in itself will give you an idea of what the market has already started to do, right? So that's the first step, determine the trend. The second step of this criteria is location. right? Just like in real estate, just like with businesses, location, location, location matters. We do exactly the same thing. So I'm going to get rid of this line up here. We're on the pound USD 15-minute chart. So the idea here is to say, or to discover where would be on your charts the best place to be possibly looking for a setup to happen. Now, a lot of people will probably just look at setups anyway. So the market's moving down here, I'm going to take a setup because it to me looks like it's moving. Or if the market is just kind of giving me a pattern down here, this to me looks like a evening star pattern. And Shiva said that when an evening star pattern forms at the low of a session or the low of the day, market's going up. So I'm going to take my entry here. Okay. And you see very quickly that if you were to take your entry here, what would have happened is that you would have probably made about 20 pips here, and then the market would have reversed against you and just kept going. So how do we determine where the best place to be looking for our trades would be? Here's your answer at your EMAs. Okay, so once you've determined the trend, your next step is to look at where price is and then look to see where your EMAs are, because it's only around your EMAs and in line with your trend that you'd be looking for some sort of structure to form where the market then convinces you to take a trade. So write down step 2, location, your EMA 200 and your EMA 50. If price is away from the 200 and the 50, somewhere like here, doing its thing down the bottom here or doing its thing here, and even down the bottom here, you can probably see that price is away, a fair distance away from the 50 and the 200, right? If price is here, you ignore it. You don't do anything with it, simply because it's not at our key location. When price comes to our location, and the location itself doesn't have to be like a complete bounce off just off of there, it can actually break it and go above it as well. And what I mean by this is this. So if the market looks like that it has established a high or a low, and it's starting to now move in a specific direction, so this market fell, it came below our EMAs, right, for probably almost 1.5 sessions, and then market starts to move back up again. We understand that when the market moves, generally speaking, it will create a false move before it moves in the right direction, right, or the most intended direction. We also know that when the market goes back and against like a previous high or previous low, they're probably going to only go to a certain proportion of that initial move, right? So what do? We use our Fibonacci tools, remember? So we grab our Fib tool and we find the previous high to the present low, and then we see where price could potentially get to. So notice how here price is actually hovering in between the 23.6 and the 382 line, right? So at this point in time, where market's just consolidating, going sideways, we ignore it. Why? Because it hasn't done what we wanted to do at our location, and our location is one of the EMAs. And so what we're waiting for is price to move up, possibly hit our location, our EMAs, go above it if it has to. It could also go up to the 618 area here, right? And then what we wanted to do, which takes us on to step number 3, is to establish some form of market structure that we recognize, right? So it could go up, and from the videos itself, you'd be familiar with what I'm talking about in regards to market structure. So let me get rid of the fibs, and I'll show you more of that in detail. So firstly, let's just quickly go back to step 2. Remember, step 1 is trend, step 2 is location, and with that means price has to come to our EMA 50, EMA 200. Here's an example of where price has come down up, hit our 50 and our 200, and then it started to form some form of structure. Price came down, right? Would we trade anything here? No. Why? Because it's not at our location, which is EMA 50, EMA 200. Price goes back up, hits our EMA 50 towards the end or middle end after lunchtime of New York, and here we can probably look to see if there's a setup. Would we personally? No, because remember from the videos, the second half of the New York session probably isn't the best time to be trading. Market goes into Asian session, it consolidates. Now, for many of you that are trading Asian session, you're probably looking to see, hey, I'd like to take a trade. And here, you'd probably say, hey, maybe I could take a trade off this next candle and then trade downwards. Why wouldn't we? One, because the market isn't at our location. It's not at our EMA 50 or EMA 200. What do I mean by that? Here, price broke past the 50 and the 200 and created a structure above it. Here, this is just doing it below it. We don't like it. Here, yes, it hit the 50 and it created a structure at and around the 50. Here, we've finally got a hit to the 50. And then the market goes into creating a structure. I'm going to define what structure is soon, okay? So don't worry about that. Why would we wait for the location to be hit? It's simply because when you see price do something like this, where it's actually not at our location, the chances of the market bouncing back up is extremely high. We want to avoid that. We want to enter into trades when the market's done its business and it's started to move in a specific direction. We want to jump into that one because that one, it's going to get you into money very, very quickly. And two, is that you'll capture your 20, 30, 40 pips in the space of like 15 minutes, a half an hour, or maybe 45 minutes or to an hour maximum. If you were to jump in here, right, yes, you'd probably be slightly in the money within the hour. It'd be about 15 pips plus spreads. But the market moves against you then, and it sits there doing absolutely nothing for about 3 hours before it actually moves against you, and you'd be out of the money for an additional probably 5 hours or so all up. And that's not how you want to trade. That's kind of pure speculation. We want to be able to recognize market movements prior to them happening, get in and be 20 to 30, 40 pips in the money very, very quickly. That's the reason why we do not take a trade when price is away from our locations. Okay? So to reiterate again, first thing is trend. Second thing is we want price to come back to our location, which is EMA 50, EMA 200. The third part of our criteria, so the third step, is recognizing a market structure or waiting for the market to establish a structure that we recognize. What do I mean by structure there? I'm talking about your double tops, right? Which would be like your M patterns, your double bottoms, which would be like your W patterns, your head and shoulders pattern, your triple top and triple bottoms, and like smaller session cups. So, like 3 or 4 sessions where the market establishes a cup pattern, stuff like that. And they have to happen at our EMA 50 or our EMA 200. So in this case, what are we getting? We get the false move up when we drew our fibs in. Let me draw that in again. Which is just another additional point of confluence. We've seen that price has hit our 382 mark and it's gone to this point here, which is at our 50 fib ratio, right? And then it's creating for us a pattern, right? So you could say that this in itself is a bit of a double top formation. Now, let me just quickly get rid of the fibs. If you were to take your entry off the next candle, right, we're looking at 20 pips in about 45 minutes. At the bottom of this little doji candle, we get our 20 pips plus spreads, right? You're in and out. Always keep in mind that when price crosses an EMA, we're looking for a retest of that EMA, always, right? And not just in one candle. We're also waiting to see if the market over the next course of an hour or two comes back to retest the EMA again. And that may establish another bigger part of that structure. So we could say for instance, if you missed your entry here, market goes back up, does a retest of this area, and then this is our confirmation candle. This could be a bit of like a Morningstar pattern as well at our EMA 50, and that gives us a now fully completed multi-session. This part of it starts in Asian session. So multi-session double top. And that should be our confidence that once the market has done this, we take our entry. And again, if you traded this and you got your 20 pips, fantastic. But if you're more of a conservative trader, you'd probably wait for this pattern to form as well. Does it happen all of the time? No. But once this double top formation actually happens, you could take your entry on the pullback of the next candle. And then again, within 2 candles, within half an hour, you've got 20 something pips plus spreads, right? So if you were to do that within the space of 1 session, you've just walked away with just over 40 pips. And for just 1 week, that's enough to make very good money with it. If you were trading 10 lots there with a pound account, those 40 pips would result in 4,000 pounds. That's effectively all you've got to get to, right? So, again, let me go through the criteria again so far. Trend, location, EMA 50, EMA 200, and then market structure, which is our patterns, double tops, double bottoms, that sort of stuff. Write them down. Go rewind the video if you have to, but write them down. The next part of it is candlestick structure. So once the market structure has been established, the 4th step would be to look for candlestick structure, right? So what I mean by that is this. If you've got the first part of a double top formation, right? Let me draw that in for you. So let's say you've got the market trending downwards, and this is our EMA. We've got the market goes up and creates a double top hit on our location. What I'm looking for is this being the overall market structure, and this part here, which is the second part of that double top formation, I'm looking for a candlestick structure that I recognize. Write this down. The candlestick structures would be our morning star patterns, our evening star patterns, engulfing patterns, pin bars, which would be, these sort of wicks to the high, pin bars, and they would require a confirmation candle after that, and a piercing line candlestick structure, right? So they need to happen at this point. So in this case, where market goes up, we've got a pin bar on this one, but market comes back down, we've got a retest, and this here, these 4 candles here combined will give us a morning star pattern at our location, which confirms for us that 4th part of the criteria, which is candlestick patterns. If we don't get that, we don't trade it. Okay? Now, here in this example, where again we're in a downtrend, market comes back up to our location, it hits our EMA 50. We've got the first part of what would be a double top formation. Market comes down, goes back up. Second part to what would be a double top formation. This again is now a morning star pattern that we've got off the EMA 50, which is the second part. You could look for an entry off of here, right? This personally for me, this tends to happen with pound pairs regularly. So I probably look at this and say this market's somewhat confused. I don't know where it's going at this stage. I'm not clear about it, so I'm going to wait. Now what you notice is that the market comes down, goes back up again, and then this here, which is a massive engulfing candle, we'll get a wick to the high as well here. It hits that. We've got a hit to the EMA 50 engulfing candle, a strong confirmation that this market's heading down. And this, if you looked at it, it's a variation on the head and shoulders pattern, right? So we've got a market structure, we've got a candlestick pattern we recognize here, and we've got a candlestick pattern that we recognize here. And this is the reason why I say to many of you, you don't have to jump in too quickly. If the market comes back and does another retest and gives you that indication that yes, I'm going to definitely move in this direction, that's when you look for an entry and you could ride it. So again, in this case, if we took our entry on the pullback of this candle, right, in the first candle in itself, you're 20 pips in the money plus spreads. See how quickly you are able to bank those profits if you're following the criteria so far. So the market gets you into the money. Now, the next step after you've done trend, location, market structure, candlestick pattern, the next part is an extremely, extremely important confirmation candle. Most of the candlestick structures that we've spoken about will give you the confirmation candle. The morning star pattern, this would be your confirmation candle. With the engulfing candles, this would be your confirmation candle. If there is a pin bar that we see, we do want the next candle to be a strong candle in the direction of our trend, right? So if it's an engulfing candle, then you know what it is. We want that candle to completely eat that up. So again, it has to be the color in direction of the trend that we recognize. And if there is a wick to the high on that, absolutely beautiful, right? Within that step, the other thing that you need to consider is that do you want to jump into that trade at the open of the next candle or on a pullback of that candle? Now, this has been a question, a key question that I've been constantly asked throughout the last couple of weeks is this. I always say to you guys, don't ever jump into a trade in the middle of a candle. What I mean by that is to say, if you know that this market is trending down and you've got your trend, your location, your market structure, your candlestick structure down pat, and then the next candle is about to open. If this candle opens and jumps straight into the red going south, I don't want you to take a trade in that middle of that candle. The only time it's okay for you to be able to jump into that trade is if that candle opens or comes down, bounces back up, and then goes into the green. If you're going to short the market, you want to take the trade, which usually is the pullback part, when the candle is green. And vice versa also applies. If you want to go long, then what you want to do is you want to take a trade on that candle if the candle is red. A lot of you I know don't like that. It makes you uncomfortable. So you can decide to simply jump into that trade at the open of that candle. Okay, so entry, you decide whether you want to take entry on pullback or at the open of the candle itself. The next step after that, once you've done that, so trend has been done, location's been done, at your location the market has given you structure, and then after market structure has been established, you've been given a candlestick pattern. Within the candlestick pattern, you've had a confirmation candle, you've taken your entry on the pullback or open. The next step is to establish a stop loss. Now, for us, we always want to take our entry at or around our EMAs, right? So EMA 50, EMA 200. When you've done that, it makes your stop loss a lot easier. So say, for instance, in this case where we've actually taken our entry here, the best thing that you can do is that wherever your the EMA has been, depending on pair, you'd actually put your stop loss say above the EMA 50 here, because our entry is here, we'd have our stop loss probably about 15 to 20 pips above that. Why? Because we know from experience that generally speaking, once the market's done its thing, it starts to move. If it comes back to say a third hit, it's going to hit the EMA. An example would be here, where if we were to look at this and say the market's created a double top at our location in a trend that's moving south, so we know that this market's going to head down. So say, for instance, you were to take your entry on the open or pullback of this candle here, this doji, right? And then what happens is that the market decides to come back for another hit. So what we would have done is we would have looked at this here and said, okay, we're going to keep our stop loss probably above this point. Notice how when the market comes back for a third hit to create the shoulder for the head and shoulders pattern, price only goes up to the EMA 50. Even if it came back up to some point here, we're still reasonably away from it where they can't open their spreads enough to stop us out. So if they were to, from say the 50 to here, they'd actually have to go up and open the spreads by 26 pips to be able to hit it, and we're still reasonably safe. So that's how you would adjust your stop loss. If then, say for instance here, you've taken your entry, you're 20 pips in the money, you can decide to exit out of that trade and be consistent with just hitting 20 pips at a time. Or you could probably say, you know what I'm going to do is I'm going to now bring my stop loss down and kind of trail that. So at this point here, you're now substantially in the money. If market continues to go south, what you could do is bring in wherever your stop loss was to possibly entry plus your spreads. So you're relatively safe If the market goes back up against you again, you'd be safe because you'd be stopped out even before the market gets to a point where you're actually losing any money. But for all extents and purposes, this criteria that I'm sharing with you, it's powerful enough, simple enough to be able to get you into the money relatively quickly, right? And in this case, with two candles, the bottom of that candle would be about 30 something pips of the money. At close, it'd still be about 30, 29, 28 pips in the money plus spreads. And that keeps going. So once that's continually going, you continually just bring your spreads down to, like in this case, the previous high, above the previous candle, that sort of stuff, right? And then bank your profits as you go. Don't get too cocky with this, because what I want you guys to do, the next step after that, is to establish your exit points. And what I mean by that is this. A lot of the times, for many of you that have said to me, Shiva, I've taken an entry, I've followed the criteria that I got in the videos, I've taken entry, markets moved in my favor, and I was like 25 pips in the money. And then, I don't know what happened, the market came against me and wiped me out. Hit my stops, wiped me out. So the first question I ask them is, well, in my videos, I tell you guys, as you're learning, you're building that muscle memory, you're building how to be consistent, why did you not take your profit at 20 pips plus spreads? And a lot of the times, they're left speechless. Now, here's the reason why I say to you guys that 20 pips, depending on currencies that you're working with, is possibly the ideal point for you at this time in your trading career to be taking profits. And here's the reason why. Pairs like pound USD, pound JPY, pound AUD, right? Or pound pairs in general. When they're moving, even if you were to get caught up in a false move, chances are that false move will probably be somewhere from about 15 to about 30 pips. So if we were to say, in this case, take this location hit and say, this is our confirmation candle, we take our entry here, you're still, by the end of this candle, 20 pips in the money. And by that time, you probably would have said, hey, I've made my money, I'm going to exit out of this trade. And you do. And then you find that over the course of the next hour, the market moves against you, right? You'd be shitting yourself for this time frame because you'd say, hey, here's an evening star pattern. Market's now moving up. This could be a W pattern now, right? That's what you're probably thinking in your head. And that will get you into a lot of trouble. But if you were to just get in 20 pips in and out, you've made money. And that's where I want your head to be. A lot of the times, people don't lose money in Forex simply because they're not able to pick trend out or they're not able to follow the criteria that I've established. Why they lose money is they get cocky, they get a little bit too greedy, and they want to ride the market for a little bit longer, and then something like this happens where the market comes back for another hit. Same deal here, where they would have taken their entry here, and then market comes back for another hit, and that hit briefly would have been above their entry point. Right? So that's the reason why if you can get in and out 15 to 20 pips or so, you'll always be banking profits, always. I don't think there'll be a situation where you're actually losing money. All right? That's how you get your 100% consistency. But once you have taken a very good entry off the 50 or the 200 and you follow this criteria and the market starts to dramatically move in your favor, then chances are that you could probably let that ride and bank greater profits. Okay? In short, guys, that's it. That's it. So I'm going to just quickly run through the criteria again. First thing is determine the trend. You're going to use Elliott wave structure, cap patterns, or EMAs being in succession, and even fundamentals. We're going to get to fundamentals at a later stage. But look at all of those things overall and say, yes, this is where the market's headed. You're going to look at location. So price, if it's away from our EMAs, we ignore them. But when price comes back to our EMA 50 or our EMA 200, that's when we start paying attention to them. What do we look for there? Market structure. Market structure would be cup patterns, double tops, double bottoms, head and shoulders types of patterns. Okay? And add to that triple tops and triple bottoms as well. And then within that second part of that market structure, we're looking for a candlestick pattern that we recognize. Morning star, evening star, engulfing, pin bar, piercing line candles. And with that, we should have a confirmation candle. And then followed by that is our entry, which is either on the open of the next candle or on a pullback of the next candle, right? Followed by that, we establish our stop loss, and straight after that, when the market has moved or is starting to move, we are counting our pips. I want you guys to consistently bank 20 pips plus your spreads, and then get the hell out of there and bank this 2 or 3 times a week. This in itself here, just by looking at this, and this, in the space of about 24 hours, we've been able to bank about 60 pips, right? So 20 here, we can get 20 here, and we can get either 20 here or here. Like, that's 80 pips in a space of 24 hours. And you can do that guaranteed every single week with at least one or two of the currency pairs. Once you do that and you're consistent with it, then what you do is you're building your accounts up, and you just start putting more and more lots onto it. One lot if you had a base account of pounds for pound USD, one lot will get you for 20 pips, 200 pounds, right? Throughout the week for 60 pips, that's 600 pounds. 2 lots, double that. 5 lots would get you 1,000 pounds for that week. 10 lots will get you 2,000 pounds for that week. That's all we're doing. So when you are so consistent with that, and you've got a decent sized account and you're building that account, you're just going to start adding more and more lots to it. But the brilliant part about this is you don't have to be a full-time trader. You don't have to be in front of your computer 24/7. You can log on, have a look. If price is not trending and not at your location, don't worry about it. If price is at your location, then you've got plenty of time still for the market to complete a structure. Once it's completed structure, you've got plenty of time for the market to now recognize if there is going to be a candlestick structure, right? The only other tool that I would recommend that you guys use in addition to this criteria that I've outlined is the Fibonacci tool. Why? That's going to give you an additional point of confluence. So you could always say, in this case, market's trending down. Here's a previous low, here's a previous high. I am going to see, well, let's do it this way. Here's the high of the previous New York session. So I'm going to do it this way. I just want to see that if the market does bounce up, where is it bouncing to? So at our 50 area, EMA 50 area, we've got a 61.8 hit as well. All of this is within the scope of this high and low, right? So that still counts. And where we've got the 618 hit as well. So what does that mean for us? We've got an additional point of confluence. Okay? And that's it, guys. So I'm running out of battery, so I'm going to leave it there. Apologies for the long video, but I needed to clarify the criteria and the strategy. I am writing a book about this, so I'm going to try and put as much detail for each step within the book itself. And there's going to be some information on the knowledge base as well in regards to this. So take it, do whatever you want to do with it. Please, below this video, write down your results that you guys have been getting. Email me, let me know as well that it makes what I'm doing worthwhile. And for those of you that really need to have one-on-one sessions, connect with Shiva.com. Go on to the purchase page. There is like roughly for about an hour and a half, 2 hours worth. The fee is $57 US. And that money goes to charity. So everything that I've created in the last 2 weeks has gone towards Tonga and the stuff, the cyclones that they've had over there. And the next step is that where, with refugees, Syria, all of that sort of stuff, we're supplying money to organizations that, provide food and water to the refugees as well. And in particular with Nepal and India, I'm actually paying or donating money to, women that have been either kidnapped or raped. There's organizations that go out there and rescue some of these women from brothels and things like that, and then give them a new life. So that sort of stuff, they do need money to sustain themselves and survive. All of that money goes to that, and I price match as well. So if we've got $1,000 there, then I match that with another $1,000 before I send it off. So yeah, that all of that is what's going on right now. So to all of you guys, this is the simplest strategy that you will ever come across. It's something I personally use as well. So all the best to you, and let's go make this world a better place together. Okay. All right. Bye for now.